Hey guys, welcome to another video by Lux Trades. Today's video is going to be a strategy video based on fair value gaps. I've had a few questions asked about this video, so we're going to get straight into it. So what is a fair value gap? Basically, a fair value gap is this gap that you see when you have a small candle followed by a long candle followed by another short or long candle. So to put it into perspective, we see these pictures that I have here in this slide. We have a short candle with a small wick, a long candle, and then another short candle with another small wick. In between these two wicks, we have this gap. That's what we call a fair value gap. Now, this green one would be a bullish fair value gap. Meanwhile, this red one is a bearish fair value gap. It can happen either direction, and it can happen at any time. So how are they formed? Basically, what I just said. You have a candle followed by a long candle followed by another candle. But the long candle in the middle creates that gap in between those wicks. That's what we call the fair value gap. It's pretty simple, and it can happen, like I said, up or down in either direction. So why do these fair value gaps matter? Well, fair value gaps can be used to trade, and a lot of people do use them to trade. For example, in this picture right here, we have a fair value gap to the upside. We have this small candle right here, followed by this long, followed by another long. But in between this long and this short, this middle candle right here, we have this fair value gap here created because you can see this wick off of the third candle is short also with the first wick. So we have this gap in between. Fair value gap usually means that the market might retrace to that spot and fill that gap. Usually there's liquidity there. So in this example right here, we continue to the upside on a bullish trend. We start consolidating, and then we break down and into that fair value gap. So what a lot of people might do is they'll hop in like a short right here for the fair value gap, or they'll see the fair value gap and they'll be like, all right, this could go back down, but I'm going to hop in right here, get in, boom. You know what I'm saying? Like, there's different ways. We're going to get into this in a minute. So how do traders use fair value gaps? Exactly what I was explaining. So right here, we have another fair value gap in this picture to the downside. So we have this bearish fair value gap here. We have this long red candle followed by with the short wick. Then we have this candle right here, no wicks, and then this other long candle right after. This is the third candle. This third candle has no wicks to the upside. So you guys can see in between this bottom wick of the first candle and the no wicks from the third candle, we have a gap. That's what we would call a fair value gap. So some people might take a fair value gap as an exit or entry point. If I was to see a fair value gap and I was confident enough to trade it, what I would do is this. Down here where we see this peak and start to reverse, this would be an ideal spot to hop in, because at this point you see that the trend is changing to the upside and we have a fair value gap, meaning there's a higher chance and a more likely chance that we might get filled at that fair value gap. So I'd hop in on a call right here, I'd buy here, wait for it to get up to here, boom, sell. What other people will do is they'll wait for us to retest the fair value gap, either to the upside or to the downside, and they'll get in right above or below it. For example, in this picture, what the arrow is showing is getting into it down here. Right after we touch the fair value gap, we bounce off a little bit, and then boom, we blast to the upside and continue in that direction. That's one way to trade a fair value gap. And honestly, a lot of people do use this method and call it their strategy. Personally, I wouldn't rely on this too much because it's not all fair value gaps get used. Or filled. Let me explain this in a second. So, like I was saying, not all gaps get filled. Some gaps sometimes we just move in one direction the whole day, and that's just what it is. We'll have 1,000 gaps, 1,000 fair value gaps, and they just don't get filled because that's just the way that the market is moving that day. So you can't always rely on these fair value gaps to make a good trade. If it was like that, everybody would be making thousands of dollars every day, but it's simply just not like that. So, want to be careful. You want to keep in mind, not all gaps get filled. You want to avoid trading them fair value gaps blindly. So avoid just seeing a fair value gap and saying, oh my goodness, it has to come back. It has to come back. Because, what if you see this fair value gap right here and then you buy right here thinking it's going to go right back up, but it comes all the way back down, all the way back up. By the time you're back there, theta has burned you out and you're probably not going to get almost anything, or you're going to need the market to come all the way up here to see a profit. And who knows if it's going to go past the fair value gap. You know what I'm saying? So that's why I wouldn't necessarily put my faith in fair value gaps. They are a tool that can be used to, you know, predict the movement of the market, but it's not something that I would necessarily, you know, really rely on to trade or to, you know, become profitable or anything like that. So recap, a fair value gap. It's basically an imbalance across three candles. We have it doesn't have to be a small candle, but we have three candles. One candle, a second candle that is long, and then a third candle. The second candle creates a gap in between the first and the third candle's wicks. In between that gap, that's what we would call the fair value gap. Fair value gaps are potential retracement zones. So usually we'll come back to them, but not always. Like I was just saying, you got to be careful. And yeah, you can use them for entries, exits, or to plan a trade. But like I keep saying, you got to be careful. You make sure that if you are going to hop into a fair value gap trade, like you want to either come back down to it or go up to it, or, you know, get in after we bounce or retrace off of it, you got to make sure you have enough confirmation to know that what you're doing is something that you can truly, you know, trust and see, like, follow through with, that it's going to go in your direction. You feel me? Another thing is, if you're going to trade fair value gaps, please use a stop loss, and please be careful with your money. Do not over leverage, because I'm telling you, these fair value gaps, they could be traps. You know, sometimes we have these fair value gaps and it just traps people. People think it's going to get filled. Boom, it doesn't get filled. Now you just got trapped and now you're just losing money. I have this picture right here. I'm not saying that people who trade fair value gaps are, you know, dumb or anything, but fair value gap is, a lot of the times, I feel like I like to say over exalted. Like, people like to see fair value gaps. I mean, people like to say, like, oh yeah, I trade fair value gaps. Oh, there's a fair value gap right here. It's gonna go up. That's not always gonna be the case. And if you honestly just rely on these fair value gaps to predict market movement, you're gonna have a pretty rough time in the market, because nothing ever has to go anyway in the market. There's a big chance that fair value gaps get filled, but it's not always. So you always got to keep that shit in mind. But that's about it for today, guys. I hope you guys took videos. Honestly, took notes. Taking notes, writing stuff down is the best way to memorize. It's the best way to, like, really ingrain something in your head and memorize it. There's scientific backing to this. You know, it's connected to your brain directly, neural pathways. It creates more of those connections in your mind. But like I said, I just really recommend you guys take notes. If you guys need to pause, go back, please do that. Fair value gaps are an important thing to know. It's just not something that I would say you have to rely on or should rely on to trade in your day-to-day, you know, trading career. But with that being said, I hope everybody has a good day. I know this video was kind of quick, fast-paced, short. There's not too much to a fair value gap. That's mainly what it is. It's pretty simple. But yeah, all right. I hope you guys have a good one, and I'll see you guys in the next video.